You're listening to the Rent Roll Radio Show with Sterling Chapman. Hey, Rent Roll Radio listeners, welcome back to the show. As always, I'm your host, Sterling Chapman. Today, we're joined with Drew Wahlgren, not Walgreens, but Wahlgren, and he is joining us from MAGCP Partners. So, Drew, welcome to the show, and thank you so much for joining us.
Hey, what's going on, Sterling? Thanks for having me on here. Happy to be here.
Awesome. And another reason to make us jealous, Drew is joining us from northern sunny California. He will be coming down to the Bigger Pockets conference. We were just talking before the recording about how I procrastinated and can't get tickets. So you guys won't be seeing me out there, but y'all try and catch up with, well, I guess this is going to air after that. So never mind. Well, Drew comes from a little bit different background than most of us. He's here to talk about industrial syndication, more or less. So Drew, can you tell us a little bit about what you do, how you got into what you're doing, and a little bit about your company?
Yeah, sure. I'll start kind of me background, how I kind of arrived here. But at one point I had bought a house here in the Bay Area and, really had a great time, kind of the valley of housing prices, right? About early 2011 or so. So, at certain points, I sold and I made, I put a lot of sweat equity into a house. I really needed it, along with just natural appreciation happening in the market. Took those proceeds and, even before I sold, really had to decide, what do I want to do here? Do I want to keep this house? I could keep this. I could rent it out. I could be a landlord and start to kind of, do the Burr method, whatever you want to call it. I guess I had already renovated the place, but I could rent this thing out, refinance, kind of go along that road. And I decided to go passive. I had a W-2 job at the time. I thought, you know what, my efforts are better spent focusing here. And I continued to see more opportunities in that W-2 corporate world. And so I said, hey, I'm going to put my efforts here. I'm a strong believer in not diluting, effective efforts that you make that are seeing more returns, right? So I said, I can go down this passive road and I can see returns that are being achieved and that are comparable, if not better, than what I'm seeing in underwriting myself when I'm doing realistic underwriting of what I could make on a rental single family home. So nothing against it. You can make great money, but part of the problem was I'm here in California. It's tough to make money.
Can't cash flow.
Yeah, you can't cash flow. It's all appreciation, right? So, hey, you cross your fingers, you hope that in 5-10 years, you're going to make a boatload. And a lot of times people do, but, especially right now,
it's not a business plan. Yeah.
This isn't a great business plan for right now because, markets have just gone up, housing prices here 25 to 35%. So you kind of go, all right, that's a big gamble. So anyway, I went down that route and invested with a few different syndication groups, sponsors, and one of them was MAGCP Partners. Got to know the principals here, really liked the strategy, the team, really down to earth, good people. So eventually, after a couple of years, I actually joined the team and said, hey, I have a network. I can bring some capital in. I can start helping with the acquisition. So I work with lenders as we're putting together new acquisitions. I work with our private investors as well. And so it's been a great time. I've been here since about mid-2019. And so we've closed, I wish I knew the exact amount of money raised and amount of dollars closed, but we currently have about $340 million in assets that we're managing right now. We've gone full cycle on about 20 deals. So certainly I've just made a robust track record and happy to be part of the team and continuing to focus where we are, which I'll just jump right into that, which we've had a focus since 2016 as a firm in single tenant, triple net leased industrial real estate. So something we focus on there. And just to be a little more specific, about 80-90% of the deals that we do, we're doing a sale-leaseback transaction. So we're purchasing a piece of real estate from a commercial business who owns and operates in this real estate. So they're looking to sell, usually to access capital that's tied up in this real estate and lease it back. And so we sign usually a 15, 20-year triple net lease at the closing of the property. So that's something we focus on. We have a lot of momentum there, and it's a really great investment vehicle for cash flow.
Awesome. So I have a lot of questions. The first, before I forget, is there a particular reason, and there might be a very obvious cash flow or underwriting reason, is there a particular reason the businesses don't just do a refinance to pull their capital out? I mean,
It's a great question. Yeah, absolutely. So, the CFOs of these companies, they're looking at a whole bunch of different options, and the sale leaseback is kind of a financing alternative to, getting senior debt from a bank. Right. But what happens when you get that senior debt? You go to a bank and they go, sure, we're going to lend you $10 million, right? It's going to come with some covenants, some rules, some regulations, basically, right? You can't break these covenants. Otherwise, you're defaulting on this loan. So there's a little bit of restrictive nature to that. But the other piece is what happens to your balance sheet? On your liability side, you just added $10 million of debt. So they're going, okay, that might be, maybe they have their own investors and shareholders to kind of appease, and they don't want to see a weaker balance sheet because, unless you have really good reasoning behind it, which they may, or they may just say, hey, we want to do some capital expenditures on the property itself, maybe. Whatever it might be, you're adding quite a bit to the balance sheet. So that's one alternative. The other one is they could take a line of credit, right? We all do this on our houses on occasion. Maybe it's to invest in other real estate, but they can do the same thing there. However, they can't access 100% of the equity tied up. It's 70% or so is generally what you're going to get. So, hey, I got $10 million here. I can only get 7. All right. Well, I have some, maybe the CEO has some initiatives we're trying to hit to grow the company. So we need more capital than that. We want all $10 million. So I can do the sale leaseback. And now I've accessed all 10 million here. Not only that, if I've kept a huge $10 million chunk off the liability side of my balance sheet, right? Rent is not considered a liability. There's sort of an asterisk there, but it doesn't kind of go on, include that, add on to that number. And the other piece is now I have not only tax deductible rents, but a really predictable long-term lease where I go, look, I got 2% annual rent bumps. That's at market, maybe even below. And I'm actually keeping myself safe from large fluctuations in rent, right? If I have a short-term lease, I know people always kind of think, hey, you want to be in a short-term lease. Well, these companies, a lot of times have been operating there for decades, if sometimes almost 100 years at a property. And they go, yeah, we'll sign a 20-year lease. And now if rents go crazy, you know what? We're going to be sitting pretty. We're going to have nice, predictable increases. So this is a way we can build our company on this very fixed overhead that we have. And sure, it's a triple net lease. And I should mention that what that means for any of our listeners who don't know is that means the tenant's responsible for insurance, taxes, maintenance and repairs, capital expenditure items. So they take on a little of that, but that's certainly in exchange for a lease rate that's lower, right? So, you may have the same property, a triple net lease, maybe it's $5 a foot, a single net or just, completely, zero responsibilities to the tenant, that's going to be much higher than that, right? You're sort of a trade-off of rent versus sort of maintenance and expenses to manage. So we're happy to kind of work in that triple net lease world because we don't want to manage that, frankly. And it allows us to scale and continue to make more acquisitions because now we don't have to manage all these expenses that happen around a property. And we know our cash flow is extremely predictable. Right. I don't have to worry about, hey, next month or next quarter, oh, shoot, property taxes went up or something broke. We had a $500,000 repair on a roof. All those things can erode your cash flow pretty good.
Oh, yeah, absolutely. Yeah. I always tell people that people often ask me like how much I make from, because I went the other route. I ended up buying a bunch of single family houses and duplexes and fourplexes. And I have the unpredictable life that you just described that you want to avoid.
Right.
And people are like, well, how much do you make off your rentals? I was like, I can't really tell. You know what I mean? Like I can forecast on a spreadsheet and try and average it out and tell you like what I should make. But like any given month could, there could be a $20,000 disaster that wipes the whole month out,
Sure.
And I mean, I guess in like looking back, which I'm not that far into it, but I guess in 20 years, I could look back and peanut butter spread it and tell you how much I averaged over that period. Right. But like in the thick of it, I'm just kind of guesstimating, what's going to break, when it's going to break, when when a hurricane's going to come and make me have 3 months of vacancy while I repair the property. And so, I definitely see the value of the triple net.
Yeah, if you're an active investor, I mean, I see this with, you can see this with like a novice business owner, for instance. Yeah, there's a lot of people who, when they open their own business or they get into active real estate investing and don't really keep organized, like kind of go, you sort of ask them what they're making and they're kind of, I don't know, it's paying the bills. Yeah.
Yeah.
Maybe they're taking some cash in, maybe they have some cash expenses. So they really don't have a great idea and a gauge of what's success, right? How well am I doing here? And what am I making, right? How do I improve on something that I don't even know where I am? So, I mean, I have this, question sometimes for passive investors who say, hey, I'm maybe I like active investing. I want to diversify over here. And sometimes it's because they want to scale. They say, hi, I got to 3 or 4 properties. I don't know if I can manage more than that. So I want to put some money over here. That's a great strategy, right? Helps you keep more work off your plate when you're already busy. But I ask sometimes, I go, what kind of return are you getting? And, they kind of, they're not quite sure. They're like, I think I'm getting around this, but, there was that one expense and so it's a tough thing. So what my advice for anyone who's actively investing is, know what you're making, do the math, sit down, because you need to have an apples to apples comparison with other options out there. And hey, if you're dead set on being an active investor, I get it. But at the end of the day, you go, hey, I've been doing this for 4 or 5 years. And you realize if I'm seeing, X amount of percentage in cash flow overall at the end of the day, at the end of the peanut butter spread out, I can tell where I'm at. Well, you might want to actually compare that with a sponsor who's in has one set of expertise, right? For instance, us, right? We stay in this lane of single tenant, net lease, industrial. So if we say, hey, this project, let's just say is 8% cash flow, and you're going, well, I'm getting like 6.5 to 7%. Well, maybe it's worth putting some capital into something like that. Or maybe it's worth abandoning actively investing altogether. I know lots of people that are doing much better than what we do in return. So to them, I say, hey, more power to you. Keep doing what you're doing because you're doing great, right? Why? You don't need us. You're making great money over here. So that's kind of something I just encourage people to try to objectively look at and don't sort of put on the rose-colored sunglasses and say, well, I think I'm doing great.
I think there's a season for everything for everybody, and it's not always at the same part of their journey. My friend, my passive investors, they always tell me they want to be active, and I always tell them I want to be passive. And it's true. You make a lot more money when you're active, but I mean the time and energy that I put into real estate, like nobody else really. I say nobody else. Like obviously, a lot of us are doing it, but like my passive investors, they're like, well, I want to. You're making a lot more than me. I want to be active. I'm like, well, I mean, it takes 60 hours a week. Like, do you want to do that? Oh, yeah. No, So you're making great money at your day job. Like, keep doing that. And I mean, I think being passive is where we all want to end up, right? We all want to sit on the beach and drink umbrella drinks and have the money deposited into our account. But there's just a difference. I always kind of envision on the front end, like you said, if you have a great paying job, I mean, it's hard to be an investor that could like replace like a really high earner, like a vice president in a corporate environment, or, some doctors and lawyers that are bringing in $250,000 to $500,000 a year. Like those types of salaries they're hard to replace in real estate. So, I mean, a passive option is an awesome option for a lot of people out there. It's not as high returns, but like if you look at like the work-life balance type scenario of it's an excellent solution. So a couple questions, and I'm sorry I ask questions in clusters. It's because I don't want to forget, and they come to me like a few of them. The first one is: did you start an industrial, or did you said you mentioned syndications? Did you maybe do a couple apartment syndications, and one of the investments was industrial, and then you just liked that the most and went with it? And then the next question is: how do you source them? How do you source the markets? How do you find a good deal? That kind of thing. What do we look for in industrial? And then finally, like what kind of returns do we? I would imagine, and you would know. I don't, but I would guess that an industrial return is maybe not quite as high as like an apartment syndication, but probably more predictable and consistent. So sorry, I threw all those at you.
No, I'll jump into it. Yeah. Some of those, I'll try to extrapolate all those. So yeah, going to when I first started, actually the first syndication I invested in as a passive investor was actually industrial, but it was flex industrial. It was a large complex. It was like 8 buildings, I believe, it was 7 or 8 buildings, each with multiple small tenants, small businesses, anything from like auto alignment shops, fabrication shops, it's just a completely different animal than we do, although it all falls under industrial, right? So you can imagine a place with, hey, there's a tenant here who's got 1 roll-up door. There's a tenant there who's got like, 10 roll-up doors, I don't want to say it's like a self-storage unit, but a little bit in that case, you have some tenants taking smaller and larger spaces. So, and that one's doing okay. It's still actually in play. But yeah, I'm in a multifamily deal as well. I'm in a self-storage deal. So I like to diversify. I love that. I really am a big advocate of the passive investing style where, hey, I'm leveraging someone else's expertise, right? Here's someone who's really got a proven track record in self-storage. I'm not going to jump into that personally, right? It's just not something I want to sink my time into learning and taking that risk on from an inexperienced operator, right? So, hey, more than happy to throw some money into someone's deal who knows what they're doing. So I went a little bit all over the place, but yeah, I invested in one deal with Mag Capital Partners before I joined the team. And I said, hey, I love the thesis here. We're talking about day one cash flow where I had invested some value add deals where I said, hey, there's some risk here that you're taking on. I call it operational risk. Hey, they have to renovate X amount of units. They have to
execution risk.
Exactly. So they have to lease up X amount of units. They have to raise rents. All this is built into the plan that they have, which is great. It's a plan, but yeah, like you said, are they executing on that plan? And to me, to be honest, I think it's not so much can they execute on it, but do they also do that in the amount of time that they're saying? When a sponsor says, hey, we're going to have this place up and running like a top at the end of year 2, you're going to be full cash flow. Well, that's the part that sort of I take with a big grain of salt, which is, I don't know, maybe it'll be done before that, but there's a good chance that there's going to be delays in construction. Have you ever worked with a contractor who's been perfectly on time? I mean, I haven't. So if you have one that's in the Bay Area, let me know, because yeah, no one ever gets their contracting work done on time. At least it's the exception, not the rule. So that's a risk that you're taking on there. And so this model here, I go, look, we're able to have a stabilized asset that has, as soon as you do a sale leaseback, there's a tenant in place. Oftentimes they've invested millions of dollars into the facility already, right? They already are in, there's nothing needed. This is a financing transaction for them. They just signed a new lease and boom, rent's being paid from day one, you're cash flowing. Great place to be. So I like that piece. And I said, hey, no one knows how a building is going to sell when they sell. We all sort of make our best assumptions and try to be conservative in how we project an exit cap rate or price, right? So that part is all taken with a big unknown. Anyone who says they do know is full of it, right? So you know that there's some risk there as well. And you look at someone's track record, at least you can point to that and say, hey, they've been pretty conservative and hit their marks. But there could be economic pullbacks that affect everyone in a similar fashion. So to me, I go, I have a really high degree of certainty around cash flow here in a property with a long lease, no expenses, and a single tenant to interact with. So I see this as very reliable cash flow over that time. So maybe you get to a point where you wanted to sell, but the whole market pulls back. Maybe interest rates spike. It could be a million different things that affect the entire industry. But if I'm able to say, hey, we could sit on this and continue to cash flow, or if by year 5, I've gotten, over half of my original investment back in just cash flow, is that really the end of the world if you sell at a flat rate? That's a bad scenario. It's not total capital loss, but if I just get my initial investment back and I average, 9.5%, 10% cash flow over that period, I'm going to call that a pretty good scenario for something that didn't go to plan, right? If I kept in pace with the S&P 500, but still got depreciation benefits. So all that, I mean, that's what I like about something that reliably cash flows from day one, because all that exit, it's all projections. You really have to take that with a grain of salt, whether you're active or whether you're investing with a sponsor, right? So we just don't know. And maybe they crush it. Maybe they do a great job. Cool. Icing on the cake, but you have to look at the downside too. The other part of your question, I think, was kind of, what do returns look like? And that kind of varies depending on where you focus on with your tenants. So with a single tenant triple net leased asset, where is the risk, right? And the risk is where, how these assets trade for, hey, is there a lot of risk here? If there's less, it's going to trade for a premium, a lower cap rate. So In this case, you could have the exact same building, exact same lease terms, but if the company that's backing that lease is Amazon, for instance, you better believe it's going to have all kinds of institutional money coming at it saying, hey, we'll put in money at this thing and take a 3.5% yield. They don't care, right? They're like, we're parking our money. We're going to keep up with inflation. This is a great place to be. And that's why we don't play there, right? There's not real yield to be found. We're looking for more than that. And our investors who join us are too. So where we're working with is typically middle market private credit tenants, meaning that they're not publicly traded. They're not, they don't have public credit ratings from Standard & Poor's, right? Where you go, hey, what's Walmart is a AA credit rating. Yeah. So we have to do a lot of due diligence. As a real estate firm, we're one of the only ones out there that actually has a whole credit analysis team. I mean, we got 3 guys that work, all day long on this stuff. We feed them all kinds of deals to evaluate, and they're consistently evaluating the assets we have under management still, right? So keeping an eye on them. We require quarterly financial reporting in our leases from them. So that aside, though, looking at these new deals, we go, look, there's a perceived level of risk around private credit tenants, right? Walmart, we all know, look, they're going to pay their rent. If they have a commitment there, it's going to happen. They're worth. Does
Walmart rent their property?
They own a lot of their properties, but they're industrial. They don't own all of it. We're working on a Walmart deal right now, but typically we don't get into that space. So we're still talking about really established manufacturers, food producers, food processors, parts manufacturers for the auto industry, equipment manufacturers for consumers. These operators are typically in the middle of the country, right? We're not talking about on the coast where I am. They don't set up shop in Silicon Valley because it's too expensive to operate.
Land is too expensive, yeah.
Right. So you got them in the Midwest, Texas, the Southeast, near where you are in Louisiana there. So they're operating there. They have a decent cost of wages there, and they're distributing their product all over the country, if not the world already. So these guys oftentimes have been in business for decades. We did a deal earlier this year with a company that's been in business over 150 years. I mean, some of these tenants, they just weathered all of these economic pullbacks, presidential administrations, and everything else that, the world has thrown at them. And they continue to operate because they're good businesses, well-managed, healthy balance sheets. And so to figure that out, though, you have to dig into their financials. You have to interview the whole C-suite of management. It takes a lot of work. But that's why we do all this, because oftentimes that perceived risk is different than kind of the actual risk. And sometimes we find out the actual risk is much higher and we walk away from it. But many times you're finding a tenant that's stronger than is being perceived. And that delta between the two, that's really where the opportunity lies, right? You're able to find a great deal, something that yields much better. So getting back to your question about cash flow, usually we're starting in the kind of 8 to 10% range. So probably better than what you might have expected, because you're used to hearing about Walgreens deals, and those yield a lot less. It's a safer tenant, right? And it is safer, right? It's a huge company, but we're trying to find a great risk-adjusted return. And so we find a tenant that we feel really comfortable with at an asset price that we feel is a very great basis in case we do end up with a dark building, and we're able to make that investment, get that kind of yield, and still see profit in 5-6 years because we paid down debt and increased rent over that time.
So at the end of the day, a majority of your due diligence is not actually on the property or the market or the ground. It's auditing the business from a credit perspective. How sound are the financials of this company? How does their forecast look? You're very much underwriting the business and its credit worthiness and for its ability to pay, the 20-year lease.
Absolutely, 1,000%. Yes, that's a big piece of it. But we're still, again, looking at the real estate fundamentals is always a great backstop when you go, hey, we're not going to ignore the downside. You have to look at that and say, in this case, what are we sitting on, right? And if I'm at a lease that's above market, I'm going to be in real trouble, right? I need to re-tenant this property. So we really like to be at a price and lease rate. It could be the same cap rate, if you're familiar with that pricing. I'm just talking for your listeners here, but if they're saying, hey, we'll decrease the price, but we're also going to decrease the rents that we're going to pay to you. That's great. I want to be below market. I want to be in a really conservative position where, if we get into a spot like that, hey, I can re-tenant this place in no time, because industrial is a really sought after asset right now. They're building as much as they can. They can't keep up with demand. I think national vacancy rate is like low 5% or something. So there's a lot of demand there. So as long as you know that, hey, I'm in a place where these fundamentals stand behind it, it's a great mitigation of the risk. But yeah, ultimately we're spending more time on the credit of this tenant, what's going on there, understanding their past, their future, where they are today, and kind of getting comfortable with, any kind of noise in the financials, right? You may look back and go, all right, we have 5 years financials, but in 2018, they had a big dip. What happened there? Let's talk to them. Let's find out. Let's get the story here. And oftentimes you get an explanation that makes sense. And sometimes it scares you away, but sometimes you go, look, we get that. That makes perfect sense. And we feel really comfortable now.
Awesome. So how are you deal sourcing? Like, where do you go to find these opportunities? Being in this space, you got a lot of brokers who work in this space as well. And maybe not just in the space, but they know, it's a very thin slice of the whole real estate economy, right? So they go, look, we got an industrial sale leaseback, boom, we have, maybe 4 people to call. Yeah, absolutely. Especially if you've done a deal with us before. They know that we're real players. They know that we close when we say we will. So that's how you get a lot of off-market deals too, is they go, hey, I just got off the phone with this seller. We want to do an off-market transaction. Great. The brokers love it. They don't have to put together a whole package. They don't have to go through the whole process that they normally do to widely market a property. And the reason a seller is okay with that is because oftentimes, again, financing transaction, they're saying we want to get proceeds in, let's just say, the end of 2021, right? So we need someone who can execute. I don't have time to dilly-dally with buyers who, halfway through the process say, oh, we couldn't get financing. Sorry, our investors don't like it, whatever it is. If they can't follow through, then that's a problem for them. So they'll come to us and say, hey, if you guys like this deal, if we can make the numbers work, you want it? And we'll take a look. And if we do, we can execute. So we get a lot there, but I'll give you one other one, which is really interesting. Private equity groups out there, they're purchasing operating companies. And when they do that, oftentimes it comes with the real estate. They don't want to tie up their capital in real estate. They go, let's spin off the real estate. Let's do a sale leaseback. And so usually they'll go through a broker, but if they've done a deal with us before, and this just happened, actually, we got a deal sort of handed to us because they said, hey, you closed on a sale leaseback last year with one of our other portfolio companies. As long as you can basically be competitive, deal's yours. And that was a great one for us. So that's kind of where they come from, have something. Sorry, go ahead. What does the capital stack look like? Like, how are you financing these deals? What's the portion of equity? What type of loan to value or loan to cost are you getting?
Sure. Yeah. 75% financing. The rest is equity, usually made up of between 5 and 10% from our group and our principals. And then, of course, the rest coming from private investors who join us. They're taking an LP position, very passive, and they're getting, a preferred return and cash flow, as well as, a split on the back end when we sell. So that's the way that looks. Not a ton there. Once in a while, we do offer a mezzanine debt offering where we'll take the equity. We're subordinate to this mezzanine debt area, maybe $5 million of mezzanine debt, a fixed rate, which takes priority over.
Can you define mezzanine debt?
Yeah. Mezzanine debt is, it's a fixed rate debt. If you've seen debt investments or debt funds out there as an investor, what you're typically seeing is something that's a first lien or first position debt. And it's usually they structure as a fund. They'll say, hey, we have all these debt. We're basically financing first debt position with a bunch of residential, let's say. And so that's that position. Now in this mezzanine debt position, they call it mezzanine, means in the middle, right? Because you're in the middle of equity and first position, meaning first position, if this property defaults, whatever is left there goes to first position first. Anything after that goes to mezzanine debt. Equity is very last in line there. So We'll say, hey, we're going to take the equity position and take the risk on for the most part. Mezzanine debt, it's much more securitized, but still subordinate to bank financing. So we might have 75% in senior financing from a bank, and then maybe another 20% in mezzanine debt. So the sort of advantages there, it's more securitized. The disadvantage is usually it's a fixed rate of return. You don't have any upside since it's not equity. And it's usually a lower rate of return because equity, you're taking on more risk. So you kind of get that commensurate return with a lower risk. But, usually still have offerings, kind of depends on the deal. But, what I've seen is first position debt offerings somewhere between 8 and 10%. Mezzanine debt can be anywhere from 12 to 15. I've seen even higher depending on the deal.
Awesome. Anything else to say about industrial underwriting, deal sourcing, or anything like that before we hop to our radio round?
Go for another 2 hours or so. But, no, that's I'll leave it there. I mean, it's really, again, for your active investors that are listening, I mean, you can go do one of these on your own. This really isn't just, there's a lot of the world that we play in is really institutional, between 10 and 20 million or more than that. We're competing directly against publicly traded REITs, but, we've seen deals that we've just sort of turned down because they're too small for us, right? $1 to $2 million deals. I mean, these are deals that your average Joe can do. And you're generally dealing with a smaller tenant though, right? It's a smaller property.
Higher risk.
Yeah. And so you really may go, look, here's Joe Schmo industrial truck repair. Okay, let's take a look at them. What I would encourage you to do is set up a triple net lease with them if they want to do a sale leaseback. That's my advice. You want to be in a position where you're not managing the property and expenses, and really evaluate their business. Get to know them well. Don't just interview the management, right? Do more than that. Look at their financials. Demand at least 3 years of financials. Talk about anything that doesn't look right. Ask them questions. So yeah, if someone wants to reach out to me after if they're looking at a deal like that, I'm always happy to give my time, get back to whoever's, looking to get into that space. If they want advice, let me know.
Awesome. So for our radio round, I got 3 questions, even though you might pass on one of them. I'm going to ask it anyway. The first one is, what's your favorite book?
I'm currently reading, I'll just go with what I'm currently reading because I'm enjoying it. It's Am I Being Too Subtle by Sam Zell, kind of notable billionaire investor. I'm listening to the audiobook because, I drive around sometimes. Yeah, exactly. Big fan of audiobooks. And he's got, I think he's in his 80s, but the guy he's pretty funny too. So there's lots of good stories. If you want some entertainment and really kind of looking at a perspective, someone who kind of zigs when everyone zags and really kind of finds the opportunities there. Great book.
Awesome. And do you have a favorite quote?
I don't. One of these days I'll, live, laugh.
That's all right.
I'm just kidding.
Hey, you don't have to answer it, but I have to ask because I've asked it 107 times in a row. So I'm going to ask.
That's fair. I'm going to get a Post-it note. I'm going to put a couple quotes on just for these times.
Yeah. And then the last one, what's your favorite thing to do outside of work?
Love to hike. I live in a kind of hilly, not super mountainous, but lots of great steep hikes. Get a little exercise, but also do a lot of woodworking. Kind of have a little mini wood shop in my garage. When you sit in front of a computer too much, you need to do something to make a tangible product. That's my thesis on, psychological management. You need to have something you make, and maybe it's just my own sort of need to be a little bit artistic too. But I like making like small cutting boards or small furniture, wall decorations, all kinds of things like that. I can kind of be a little creative with, but still sort of have a finished product that I can sink my nails into,
Awesome. Yep. Can't argue that. How can our listeners find out more about you and MAG Capital Partners?
They can go to our website if they want, magcp.com, or they can email me directly if they just want to reach out. I'm always about to give out my phone number, and then I realize it's probably a bad idea, but they can email me directly and call me after that if they'd like, drew@magcp.com.
I give out my phone number when people interview me on podcasts, and I've had some weird folks call me.
I was about to say screw it and just do it, but just email me. I'm positive I will get nothing but good people if anyone's interested in talking. You seem like a good guy. I think all your listeners are an extension of your personality. That's how I see it. So yeah, if you want to talk shop or talk about opportunities that we're working on, feel free to reach out.
Awesome. Drew, thank you so much for joining us. I really appreciate it. I'll definitely be following up with you and following what you guys are doing over at MAG Capital. Interesting space that I think a lot of us could definitely learn to appreciate from a diversification standpoint. So have fun next week in New Orleans. If somehow I make it out there, I will definitely hit you up.
I need an advice just for our listeners too. You need to give me one restaurant to eat at while I'm in New Orleans, downtown.
Downtown New Orleans. I don't go to downtown New Orleans as much as I
Only the tourists go there.
Commander's Palace.
Okay.
That's one.
Okay. I'm making a note. And if it's horrible, I'm coming back to tell you.
Let me know.
All right. Appreciate it. I'll tell them you sent me. All right.
Do that. They actually know who I am. They used to be a customer of mine. Perfect. All right. Thanks, Drew. Have a good one.
Thanks, Sterling. You too.
Thanks for tuning in to the Rent Roll Radio Show, brought to you by Crestworth Capital. We hope you enjoyed the show, and if you did, please hit the subscribe button and leave us a rating and review. You can also visit us at crestworthcapital.com or rentrollradio.com, or follow us on Facebook at Rent Roll Radio or at Crestworth Capital. If you would like to reach us, feel free to shoot us an email at info@rentrollradio.com or sterling@crestworthcapital.com. We hope you come back next week to join us on some more of our journey. Until then, happy investing.